We are live. Money Mondays. We do this every Monday at 3:30
Central. Welcome, everybody.
Boom.
Thank you guys for coming on back. We're excited to have you.
Who are we?
Disrupt Equity, based in Houston, Texas, and Money Mondays. So we're here to talk about multifamily investing today. I just got off an hour-and-a-half call where we were just dialing in to the T what we think all these deals are going to need. So it's a kind of wild world out there versus kind of where it was 6 months ago. So lots to talk about.
A lot of things in flux, folks. Not all bad, right? I want to go ahead and preface today's, show that we're trying to provide data, right? We still want you guys to do your own research. You need to talk with your vendors, with your team, with your legal, your financial, your CPAs, your mortgage brokers, all those people, because this stuff is in flux, right? And we have some pretty good data points because we've got 6 deals that we closed 2. So we got 4 more to go. We got 2 that are closing next week, and then we got 2 that are closing in September. So we got a pretty good, thumb on the whole pulse of this thing. And we're going to share some of that today. So let's get right into this. Some of the questions that kind of came in before the show. Where's the economy today? Job growth, rent growth, inflation, housing prices. Pretty big question here. I would say that the economy is on fire. Yeah. That's the reason why you have inflation, right?
Economy's doing good. I mean, last week's job numbers came back double what they were expecting, so it's actually more healthy than expected.
Yeah. So what does that mean? So that means that obviously you've got inflation, right? Inflation is kind of driven by obviously a bucket of different things that are getting more expensive, right? You've probably felt a little bit of pain at the pump and a little bit of pain at the grocery store, right? Your rent, your mortgage, if it's a fixed rate, it's going to be the same, but rents are going up, right? Which is good for multifamily. In fact, that's one of the reasons why they say that multifamily is a good hedge against inflation, because we can re-rack our rents every 6 to 12 months to keep up with those rising expenses, right? So we're able to kind of keep going up like this, whereas if you had, say, an office and you're locked into a 7-year lease with one of your tenants, your expenses are going to go up, but your rent is essentially flat, right? So you just have to kind of take that into consideration, right? But I mean, job growth in most markets, including the Sun Belt that we're invested in, which includes Texas and a bucket of other states, is going pretty good, right? And that's why the Fed is having to increase interest rates, right? They're trying to slow down the economy. They'll call it throwing water on something that's on fire, right? And they have to do that in order for inflation to kind of come back in line. Now, is it going to get back to that 2% rate?
Hope
I don't know. Maybe. Who knows? You just, it could be 3, it could be 4 for a little while, right? It might take several years for that to kind of damper, but what we think is going to happen is interest rates are going to kind of continue to kind of go up maybe through the end of the year. They're probably going to stay there for a little while. They're going to see what's happening. This is the Fed, that is. See what happening is the economy kind of going down. If so, interest rates are going to kind of follow that same thing, right? Because what the Fed is, two-pronged approach of what the Fed does. They try to keep inflation in line, and they try to stimulate the economy, right? So it's a balancing act. That's why there's going to be a soft landing, or there's not going to be a soft landing. Nobody really, really knows, and that's why there's so much uncertainty right now, right?
Completely agree.
Boom, boom.
So
All
keep going. So let's see, what else do you want to kind of add to it?
I think that's probably, a good start. But what are some of the economic changes you think are going to happen in the next 6 months?
We do think cap rates probably plateau or decompress a little bit, right? I think that's a reality. But I think the big thing for people to realize is how people are modeling their exits on these refis, right? I think that's the what's the word I want to use? The Trojan horse, maybe, that kind of see what ends up happening, right? Because you are going to have some deals that thought rates are going to be much lower and the DSCR constrained and they're going to get nuked on proceeds, right? So are those people going to have the cash to refi? Are they not? And so it'll be interesting to see what happens with those subset of deals and how those come back to market, what ends up happening. But it's about, playing it safe, folks.
Yeah, no, I think so, right? I think what economic changes could we see over the next 6 months? I kind of alluded to that just a minute ago, right? Interest rates are probably going to tick up, then they're probably going to tick down. And next year, we're going to be battling inflation probably for the next few years, right? But I think rent growth, I think job growth, I think population growth, especially in Texas and the Sun Belt states, is just going to continue to get just to be strong for quite some time, right? As you've seen, this is all in the news. We love our California peeps. We love people on the West Coast, East Coast. It doesn't really matter where you live. We love everybody out there. But a lot of people are moving into these Sunbelt states, right? And that trend is not something that's going to reverse itself, right? That wasn't because of COVID. What ended up happening was COVID was an accelerator to something that was already been happening for quite some time. That's why we've been investing in those pockets for the last 8 years. So that we're not doing anything that's new, right? It's just that it's accelerated because, again, some of the legislation and the tax situation that's on the coasts is just not conducive to growth, right? And so a lot of companies are fleeing those states and moving to Texas and the Sunbelt states, and that's why we invest there, right? So you're going to continue to see that. You're going to see the Fed continue to battle inflation, right, by increasing interest rates. We kind of have a roadmap as to probably what they're going to do, but everybody's just doing the thumb in the air for the time being. And then again, that's probably going to slow the economy down a little bit. And at the end of the day, hopefully we can get back to a little bit of an equilibrium, and probably late 2023 into 2024, right? So what do these economic impacts have, with rising interest rates, sky high inflation, right? Does this ultimately impact the macro situation in the United States?
Inflation means rent growth.
Well, we know that, right? So. I think it's more so what people want to know is, is it going to crater real estate?
No.
And I think we brought something up on this, and I wanted to get your perspective on this.
Ultimately, I don't think it's going to create a real estate. I think, again, you're going to see softening, and that's fine, right? Things are cyclical, right? Things happen, and that's fine. It's about, as a investor, as an operator, it's about just having the reserves, being resilient to work through it, right? And time heals all wounds in real estate. And so
we did. We heard that from one of our friends, right? I think, Eric, it was not you. That was definitely not you.
Who else said that one?
Eric.
I know I heard it from somebody.
Yeah.
Marvin?
Yeah. Yeah. He just said, he said that, the one thing that he said was, that, if you're in a deal long enough, whatever might have happened in the past is essentially going to,
and so
be
I think ultimately you'll see softening of real estate, and that therein lies opportunities. We got a call back the other day from a deal that we looked at 5 months ago that's back on the market. So again, it's about getting into deals structured correctly, right? Plenty of reserves. And then, right now, I think there's not a lot of buyers. So right now you can find some deals. And so for us, we're really evaluating what do we do next, right? After we kind of get the current deals across the finish line. So it's good stuff.
No, I love it. I love it. All right. So what are we seeing operationally over the next 6 months? With these kind of headwinds,
It's going to be the year of the operator. I think operations are going to really show.
I think so.
You're going to see which deals came in too tight and which deals didn't. So I think that's the name of the game here.
Yeah. So, I would say vacancy is still going to be very, very tight, folks, right? I think the one thing, again, that I love about multifamily is that there's a housing shortage, right? And so what people need to understand is that is going to lead to people either staying in their rental property longer or vying to try to get into a rental property, and that's where you have pricing power, right? They're just not building enough of this stuff, and they're certainly not building the B and the C class stuff anymore, right? So that is going to allow people to be at a price point that is still somewhat affordable for everybody, but but it's going to allow them to kind of stay in that place because they're not going to be able to afford a house or they're not going to afford the down payment, right? I think rent growth, like we talked about, is still going to be there, especially in these Sunbelt and these Texas markets. I think cap rates, there might be some expansion, or there has been. I'd probably say 25 to 50 basis points, depending on the market already. I don't think that that's going to go much above probably another 25 to 50 at most. In fact, I would probably say that it's probably going to stay about like this, right? So if it's a 4.5 cap market right now after that expansion, it's probably going to be 4.5 to, call it 5 for the foreseeable future. I just don't. People think that 8 cap deals are coming back. That ain't going to happen. And now you can mark my words. You can mark this video, and you can call me a liar in 5 years if it ultimately ends up being the truth. But that is my prediction: is that the 8 cap deals are just never going to be the case. Multifamily is too hot. There's too much shortage of housing, and there's too many great fundamental drivers that are driving the valuation and the rents at these properties that it's just going to perpetually keep cap rates at a lower level than they've historically been over the last 20, 30, 40 years, right? Retrates. We talked about them, right? Our deals getting retraded. They're absolutely getting retraded.
Yes, they are. Across the board.
Across the board. People are still doing it. It's kind of starting to you're starting to have some price discovery in the market where things are kind of starting to settle.
Trying to get some sellers and buyers that are aligned versus complete disconnects on, hey, here's what we think I'll get, here's what I think I'll pay, and there's just a big gap between the two.
There was, right? At the beginning of the summer, there's a huge gap, right? Where deals that were marketed in the beginning of the year or into the spring, right? We're getting under contract, and then there was just this disconnect between the two, and that's where that price discovery is now happening, where brokers are now kind of starting to get a little bit more in line with where it should have been in the first place. Because I always kind of describe it as a broker's premium, right? Where it should have been was probably 5 to 10% below, but the broker's just throwing out stuff to see if they can get anybody to actually bite on it. And so it's just coming back in line with where it should have been in the first place. So retrades are still happening. I would assume that that's probably still going to be the case throughout the end of the year. And then again, that price discovery, that equilibrium is going to continue to kind of come in line, and we will see less and less of that, because that's not the normal thing that's happening, right?
I agree.
So realistic concerns investors should be aware of in today's market. I think we touched on this.
I think we touched on them all.
Yeah, right. Just make sure you have your reserves. So if you're going to be investing in a deal,
no caps are expensive, right?
Just interest rate caps are expensive.
We may pay about $1.5 million for one right here shortly.
That is what it is, right? Some of these deals that we're buying are massive. So, at the end of the day, you have to be aware that your closing costs might be going up. You're going to want to have some additional reserves, whether it just be to weather some kind of a slowdown or to get out of the deal on a refinance is always a good thing, right? And just be investing in markets that have those fundamental drivers behind them, right? That population, that job growth, legislative friendly, tax friendly, business friendly, landlord friendly states, right? Not to say that you can't find deals in other states and other parts of the country. We get all that, right? But why go against the grain when it's a lot easier to make some money in some of these easier markets, right? It's all, what is it? All ships rise with the tide. That's what's happening in Texas and the Sun Belt. So, boom, got through that. Any other final thoughts?
No, it's just interesting times, right? So, it's about, we're in the situation, people were wondering what happened, right? We're there, so now it's about, hey, working through the adversity and solving problems. And so, I think that's where operations is key. Invest with people that have management companies in-house or have a really close relationship with one, right? People that understand their numbers. And people that operate a little bit tightly. I think that is where things will kind of live and die right now with deals that people are getting into.
Yeah.
Let's see, Ken, if you have comments, questions, please ask them. We'll answer them here live. Rick Gonzalez says, hey, everyone. Rick Gonzalez from Houston, Texas.
Hey, buddy.
What's up,
Thanks
Rick?
for tuning in.
Let's see, our buddy Jeff says, what are you doing specifically to protect against the downside and making sure invested capital is protected? Yeah, great question. I just got off of an hour-and-a-half call and another one later, just really sharpening up what does a worst case look like, right? We have the SOFR forward curve, whether you believe it or not.
Yeah.
You have interest rates cap, and just say, let's say we close today and tomorrow, rates go to 100% or something stupid, right? Rates go to 20%.
Oh,
what does it look like for the next 3 years, right? And then, really getting a sense of what does the refi look like, right? What capital needs to be brought to refi and accomplish that or hit distributions?
Yeah.
And so it's really having that lens of what do we need to be able to hit our numbers? What do we need to be able to refi, and making sure we have plenty of cash. Guess what, folks? It's okay to raise another $3 million and give investors 2% less return than it is to say, you know what? We're going to run it tight and take on all that risk.
Or have to go to do the dreaded cash call,
Absolutely.
right? We have had so many affluent investors saying, hey, don't talk to me about return on my capital. They talk about return of my capital. They're looking at us on how are you going to mitigate the risk involved in the investment. And I think, not only having tight operations, vertically integrated firms, good cash reserves, but also just structuring your deal in a proper way, right? I would say the other way that we're trying to, insulate our deals from risk is structuring them properly. And what do I mean by that, right? Putting the right capital stack together is important, folks. Understand how debt works, right? And I'm going to give you an example of what we're trying to do. We're coming in even lower leverage than we typically do. And we're not a high leverage shop anyway, right? But we're coming in 60, 65% LTC on all of our deals. right? We're getting as long of a bridge term as we possibly can. We're getting the best spread that we possibly can, and we're buying very tight interest rate caps and that's all in order to mitigate the risk on these deals, right? Because if you're at a lower leverage, whenever you go into a refinance, the success of that refinance is that much more guaranteed. And I hate to use the big G word, right? But it makes it a lot easier to get out of those loans and get into a permanent loan, right? I think what's going to be interesting to see over the next year, 2, and 3 is going to see people that were high levered going into these deals, and how are they going to refinance out, right? And is that going to result in a tsunami, so to speak, of deals that hit the market because they have to sell, right? And is that going to be some kind of a discount pricing situation? Who knows, right? Nobody has a crystal ball, but we typically want to start off getting into the deal on the right foot, so we have the right debt structure. But I think that's another important thing. And check it out. We use Anton Matley, Peak Financing. He's the savant when it comes to this stuff, right? And I think the other thing that people need to look into is debt service coverage ratio, right? This is where you need to understand how Fannie and Freddie on those permanent loans underwrite the deal, right? Because I think people get caught up on LTVs and, I'm going to be 70% LTV and that's going to be all right. That's not necessarily how they underwrite the deal. That's not how a refinance is actually going to happen. So you just need to be taking that into consideration, get some advice, do some research, understand how this works, right? Because you don't want to get caught short at a refinance where you're $1 million short to even get out of the deal. What are you going to do then if you don't have your cash reserves, right? So, something to think about, right?
All right, let's keep going. Next question. Thank you for this episode. Who has an apartment buying mentorship program local to Houston?
There's a couple, we're not big on suggesting ones, but
there's a couple. There's,
I would say there's three.
Mentor,
I wouldn't suggest those guys, but I'd say Lifestyles. I'd say Brad Sumrock, and I got Mark Kinney's Think Multifamily.
Well, they're saying local to Houston. That's what I was trying to say. Kind of that was
RE Mentor's out of Boston, so Lifestyles.
Sorry, no, I said the wrong one. Not the RE. The other.
It's Lifestyles Unlimited.
One more, I forgot. Anyways, we keep going.
Yeah, but check those guys out. We're not here to make any recommendations on that type of stuff, but there's some good folks out there. We do know Mark. Mark Kinney's a great guy. I think Multifamily as well. He's here in Texas.
All right. Let's keep going. Any more comments, questions, thoughts? Otherwise, we will keep going. If you have comments, questions,
everybody knows everything about the economy.
Well, I think the assumption that nobody knows anything about the economy. That's our thesis. So
yeah, we're just rolling. We're rolling with it. And again, it's all about mitigating risk because these things could potentially pop up. If they don't, then that's the gravy on top of your deal, right? But it wouldn't be a Money Monday without us talking about Multifamily Investor Network Conference.
Coming up, August 26th is the deadline for the Atlanta conference, coming up November 12th.
Get some more coffee.
I don't know, I read the wrong date, all right? But it is November 12th coming up in Atlanta. It's our MFIN, Multifamily Investor Network Conference. The best conference in multifamily, as we like to say. Should be some awesome speakers, great lineup. And again, it's all about getting good people in the same environment.
Who did we have on the last one?
Last time we had Brandon Turner, Neil Bawa, Robert Helms, Tom Wilwright. We
bunch of panels, a bunch of networking.
Anybody and everybody. So
great
Brandon
time.
Turner, I guess I didn't say that one.
You did say that one.
Who else? I feel like I'm missing somebody. I got to have all the people.
We got the four main guys, and we had some great panels about all kinds of different topics, right? It's going to be, it's a conference for networking. You're going to get some education. If you're a passive investor, we have a track for you. If you're a GP or an active investor looking to do your own deals, doesn't matter if you're syndicating or not, right? We've got some great content for you. But yeah, check it out, November 12th, Atlanta, Georgia, where we have some assets. We're trying to think about maybe doing a property tour too, but stay tuned for that. But check it out, mfinvestornetwork.com. Put in the coupon code EARLYBIRD to get your $150 off. Shanna does not allow us to make any money on these. But prices will be going up, so check that out before August 26th. But if you're around this week, this Wednesday, we got Bronson Hill. Oh my gosh, how to raise $12 million in the next 12 months. Hey, if you want to raise some capital, you need to raise capital for your deal. You want to raise capital in the future. Check out Bronson. He's been prolific, done a great job marketing himself and being able to raise capital. This is our virtual meetup that we do every month. And so check it out, disruptequity.com/virtual meetup to get registered and check that out this Wednesday, August 10th, 7:30 p.m. Central Standard for Bronson Hill, how to raise $12 million in the next 12 months. But what's coming up next week, buddy?
We're talking about what is a good return on a real estate investment today.
Oh my gosh. Have things changed a little bit? Probably.
A lot of it.
But, the fundamentals are still there. Multifamily is still strong. So stay tuned next week. What is good return on real estate investment? We will see you there.